Hi, and welcome to this special edition video. We wanted to offer a follow-up about 2024 tax implications. So we brought back the wonderful Steve Blake, principal at CBIZ Somerset, to discuss the new bipartisan tax bill that just signed into law by President Biden. So welcome back, Steve. It's lovely to see you again.
Yeah, thank you. Thank you for having me. I appreciate the opportunity.
Well, can you give us an overview of what this bill is? And then we have some questions afterwards.
Sure, yeah. So as just a high-level overview of the bill, we kind of talked about on the last session, there were these multiple tax provisions that had expired or kind of phased out from the Tax Cuts and Jobs Act. We referred to some of them as the Big Three. And there have been several bills kind of introduced trying to get these passed and corrected and fixed for some of these phase-outs. Mm-hmm. And none of those have really gone anywhere. And then suddenly at the end of January, the Republicans and Democrats kind of came together and agreed on some of these provisions. So the big three that we talked about before, it's the deductibility of the research and development expenses, the bonus depreciation, and the calculation of the limitation for interest expense deductions. And then those were the big three for the Republicans. For the Democrats, their big ticket item was the child tax credit. And so this bill also increases the refundable portion of the child tax credit, while also giving the Republicans the big three that they were looking for. So kind of a compromise between the parties.
Huzzah.
Yeah. Amazingly enough, in this political environment, it looks like they're actually going to be able to come together on a few things.
Great. So glad to hear it.
Yeah.
So if I'm a business owner, what should my overall impressions be of the tax bill?
All right. So because of those big three provisions, the ones that I mentioned, this bill is very business friendly.
Great.
Obviously, the child tax credit is very family friendly. So the name of the bill actually invokes both families and businesses for the Tax Act. So from a business perspective, those big three, if you can fit within those and your circumstances allow you to take advantage of them, then this Tax Act is extremely beneficial. I will have some clients that will go from a seven-figure taxable income to a seven-figure taxable loss as a result of these provisions.
Oh, wow.
Yeah.
Okay. So we talked a little bit about interest rate deductions during the webinar and podcast last month, but with this new bill, what are the changes to interest expense deductions and how will the changes impact the affordability of loans or impact my balance sheet?
Yeah, so that's a great question. I think in terms of the affordability of those loans, this will definitely help. Again, depending upon your circumstances. So the big change coming out of this act is there's a limitation in the amount of interest expense that can be deducted. And that also then might impact whether or not you can take bonus depreciation. So in 2022, the limitation was changed. So for years, starting with the Tax Cuts and Jobs Act in 2017, that started in 2018, we were allowed to take up to 30% of our adjusted taxable income as an interest deduction. Now, with the pandemic, there were a few changes. There were a couple of years where it was 50%, but the key here is the calculation of that adjusted taxable income. So for years and years, we were allowed to use what's called EBITDA, essentially, earnings before taxes, interest, depreciation, amortization.
Thank you for that.
Yeah. And so in 2022, it changed. We could no longer add back depreciation and amortization. So that limit, that 30%, was based on a much smaller number. So our limit was a much smaller number. And that started in 2022. This bill actually goes back and changes the law for 2022 and goes back to that EBITDA calculation where we can take advantage of adding back the depreciation and amortization. That 30% is of a much bigger number, which means we're going to be able to deduct a much larger amount of interest expense. So that means with this being retroactive to 2022, clients can actually go back and amend their returns for 2022 if they were limited, but would not be under this new calculation. So it could have a significant impact on going back and amending and even getting refunds back for 2022 of significant dollar amounts. So the way that would impact the affordability of the loans then is by being able to deduct the full amount of that interest expense. Obviously, the cost of our loan is cheaper. So that increases our cash flow. It allows us to pay back that loan faster or do improvements, maybe put that money back into the business at a significantly lower cost of that loan.
Hey, that's great to hear. Okay. So how does this bill affect depreciation taxes then?
So there are really three provisions that impact depreciation in this bill. So I've already kind of talked about the limitation for the interest deduction. Now, if we've got businesses out there, taxpayers that have floor plan interest, which is a special type of interest related to, it's kind of like a line of credit for inventory. So if you've got floor plan interest and your interest deductions were above that limit that I talked about for the deduction, then you were not allowed to take bonus depreciation.
Okay.
So with that limit being increased, fewer businesses are going to be subject to that limit, which means they will be able to take bonus depreciation. So for those businesses with floor plan, it's kind of a double whammy. Not only do you get to deduct the full amount of your interest expense, but if you're still under that limit amount, even with your floor plan interest, then you still get to take bonus depreciation. So then the second related provision then is that bonus depreciation. So bonus, the way that works is you're allowed to take a percentage of the cost of your asset purchases as a deduction. Typically, the way it works without bonus is you would deduct those over the course of the life of an asset. So let's say you buy a car for your company. You're allowed to depreciate that over 5 years. So it would take you 5 years to fully deduct the cost of that car.
Okay.
With bonus depreciation, and cars are a special circumstance, so let's use a piece of equipment. A piece of equipment would be 7 years. You would depreciate that over 7 years. With bonus, you can take the entire cost of that in the year that you put it into service with bonus depreciation. But under prior law, prior to this act, bonus started phasing down. So instead of 100%, it went down to, in 2023, it was 80%, and then stepped down 20% every year from there until it was zero, and bonus didn't really exist at that point.
Right.
What this bill does is it says, okay, we're going to stay at 100% bonus depreciation through 2025. 2026, we're going to go down to 20% bonus depreciation, and then no bonus depreciation after that.
Okay.
So what this allows us to do from a depreciation perspective is those fixed asset purchases. And some companies have millions and tens of millions of dollars worth of new assets they put into service every year. It'll allow us to fully deduct the cost of those in the year that you purchase those for at least the next few years.
Oh.
And then the third provision related to depreciation is, and this one's a lot more minor in terms of the change, but there's an election, it's called a Section 179 election. And in situations where maybe bonus doesn't apply, you can elect to deduct the cost of those fixed asset purchases. But it is a lot more limited. So there's a dollar amount threshold, and then it starts to phase out.
Okay.
So it's very limited in what you can do. Essentially, once you get to the point that you've put in fixed assets of about $3.8, $3.9 million, you're completely phased out. You can't elect 179. So for companies that are putting in significant amounts of fixed assets, 179 is kind of limiting. This bill increases those limits. Now, it's not huge. It's a couple $100,000, but still that's something beneficial. So with those three provisions, whether you get to take bonus depreciation or Section 179, you've got a lot more opportunity now to get those deductions in the year you put the assets in service rather than over 5, 7, 15 years.
Wow. So how will these changes affect the people I would serve as an insurance agency?
So I think a lot depends on the circumstances of the business. So with these provisions, whether or not they do research and development, which we'll talk about, whether or not they have issues with the interest limit calculation, or whether or not they can take bonus or 179, depending upon their individual circumstances, which is why you really kind of have to look at this on a business by business perspective. If you can benefit from some of these provisions, we could be talking pretty significant amounts. Like I said, I can think of one client off the top of my head that's going to go from a 7-figure taxable income to a 7-figure taxable loss as a result of this.
Wow.
That obviously impacts the amount you have to pay for your taxes.
Sure.
They're going to go from having to pay probably a high 6-figure, low 7-figure tax liability to zero. So they can take those funds and kind of put them back into the business and help grow the business or create competitive advantages for themselves.
So what changes are made to the adjusted taxable income that could help benefit businesses?
Yeah, so that's a great question. Kind of like I mentioned before, it really depends on their individual circumstances and which of these provisions they can take advantage of. So we've kind of talked about being able to deduct your interest expense. We've talked about the bonus depreciation, the Section 179 election. One thing we haven't discussed yet is the research and development credits and the research and development expenses. So historically, Prior to 2022, you could have research and development expenses that you get to fully deduct.
Okay.
On top of that, you would get a tax credit. So you kind of get a double benefit for doing research and development. It's an incentive that Congress put into the law to really get research and development happening inside the United States. And so one of the things this provision does, because under the previous law starting in 2022, those expenses were no longer just deductible that year. You could still get the credits, but you couldn't deduct the expenses on top of that. What Congress said is that if it's expenses that take place inside the United States, you have to amortize and deduct those over a 5-year period. If they happen outside the United States, you amortize and deduct them over a 15-year period.
Okay.
So for those companies doing research and development, and let's think about those large research companies, pharmaceutical companies that spend millions and billions of dollars on research every year, that is a huge change in their adjusted taxable income. Even for the smaller companies, we've got a lot of companies here where we're sitting in the state of Indiana that are manufacturing companies that are constantly kind of tinkering with their product and kind of figuring out how to improve it and make it better. Those types of expenses qualify, but they also are subject to this limit and having to be deducted over a 5-year period.
Okay.
So one of the things that this new act does is it goes back and says, okay, for expenses in the United States, you're going to be able to just deduct those instead of having to expense them over a 5-year period. So from a taxable income perspective, pretty much every provision in this bill allows you to lower your taxable income if you can fit within the provisions.
Great.
And then we've kind of talked about in the past on some of our discussions that, within the Senate, you have to have some kind of revenue offset.
Right.
So if we're going to save people tax money, you got to take it away somewhere else. It's kind of got to be revenue neutral over a 10-year period. So one of the things that Congress did here, probably the one thing, and most of our clients and people that are listening that qualify for this have already done it, so it's not that big a deal. But the employee retention tax credits that we've heard a lot about in the news, Congress is not very happy about. There are a lot of people out there making a lot of fraudulent claims. There are a lot of promoters out there that are just qualifying everybody and making these claims that are very fraudulent. And so Congress, in order to pay for this, said, well, we're going to cut off that program as of January 31st. So it originally went until April 15th. So they're closing it a few months early. And that's how they're paying for all of these provisions. So assuming you've already gotten your ERTC filed, and most of my clients have already even gotten the money back, really the impact of this act is the fact that your taxable income is going to go down.
Okay, great. Thank you. So tax bills tend to have great effect on smaller businesses where the dollars matter just that much more. So smaller firms may perceive to have little to no research and development expenses. Is this an area in tax that they may be missing, or do any of the changes affect how they're doing business?
So for the research and development portion of this bill, I would say, to answer the last part first, because that's easy, no, it doesn't change what they're doing.
Okay.
If anything, if they want to take more advantage of this program, they can change what they're doing. But for the most part, what I have found working with my clients, that I walk in and we do an analysis on whether or not they qualify for research and development credits and taking the deductions. What we find is that a lot of companies are already doing things that qualify, but they're not aware of the credits, how to calculate the credits, what they can do to get the credits. And so a lot of times what we find is we walk into a business, and sometimes even if I'm working with a prospect and I just go on a tour of their facility and I see what their employees are doing, I can start asking questions and eventually find out that they're doing activities that would qualify for the credit.
Yeah.
So most companies that would qualify for the credit are probably already doing what they need to do. There's nothing they would need to change in order to qualify for the credit. It's more a question of being aware of the credits, aware of the deduction and the impact of those, what qualifies as research and development, what are those activities? And then the fact that these credits are available, and talking to your tax professional in order to make sure you're claiming them.
Okay. So when looking holistically at the bill, as a small business owner, what is the maximum someone can expense, and what is the phase out threshold amount? Yep. How does the tax bill change all that?
So all of these provisions are a little different. What I would tell you is, from a bonus perspective, if you're not limited because of the interest calculations, because of the floor plan, bonus is unlimited. I mean, you can put as many new fixed assets into service, and if you qualify to take bonus on it, there is no phase out, there is no limitation. You can take advantage of that.
Okay.
Same thing with research and development expenses. There is no limitation, no phase out. If you're expending money on research and development, you can take advantage of those deductions, and you can also qualify for credit, which is a calculation based on those expenses.
Great.
So the limits that come into play then relate more to the interest limit that we've talked about, which again is going to be 30% of that calculated adjusted taxable income number, that EBITDA number that we talked about. And then the other one relates to the Section 179, where that one does start to phase out. I don't have the numbers right in front of me, but typically speaking, somewhere in the ballpark about 2.7, 2.8 million, it starts to phase out. They increased the limit to roughly, I think it was 1,220,000. So once you kind of hit that phase out threshold, that roughly 2.8 million, every dollar of new assets above that, you lose $1 of that roughly 1.2 million that you can take as an election for. So by the time you get up to the ballpark of $3.94 million of new assets, you're completely phased out of being able to take Section 179.
Well, thank you so much for all of that overview, Steve. We really appreciate you coming in to talk to us.
Thank you. I appreciate the opportunity to come in and share some information with your clients.
So for those who want more information, remember that it is always a great idea to work with a tax professional who are well-versed in the tax law and its changes. So stay tuned for more. Thank you and have a great day.